Global bond markets are in crisis. Martin North, John Adams, in the interests of the people. Hello, John.
Hello, sir.
Well, are we in phase 3 of the crisis, do you think?
We started at the beginning of last year talking about the economic Armageddon had started. So I've been writing about this since about 2016, 2017 in the Australian press. And what we talked about at the beginning of last year was the repo market blowing up in around August of 2019. Then we started the pandemic last year, and then the markets blew up in February and March, and that's when they announced QE to infinity, and that calmed everything down. Now we enter 2021, and we've gone now into a third phase of this economic Armageddon thesis that I've been promoting, and it really blew up in the last 2 weeks. Now, what's the cause of this? So. In the last 2 weeks, we did a show about my thesis of accelerated stagflation. So the thesis I put forward to the audience last year was stagflation had started, which is low economic growth, high unemployment and rising prices. And we went through a number of shows last year about that. Then 2 weeks ago, we did a show and we went through the Biden policy agenda, particularly on the economy, and I basically said that he was going to fasten this process of stagflation because of additional stimulus, 1.9 trillion on COVID relief, 2 trillion on climate change, and there's a whole host of regulatory policies which were going to cost jobs and drive restrict economic supply and then drive prices up from the supply side. It would appear to me that the market, so this is now a global phenomenon, but it really started in the US. The US bond market has really picked up on this thesis that I put forward. And the fear that has been raging through bond markets across the world, starting in the US, is that inflation is picking up. And if inflation is picking up, that means that the real rate of return on bonds goes down. And people don't want to actually have a financial asset where they're losing money. So what we have been seeing is a sharp sell-off in bonds across the world, particularly long-dated bonds, that has driven up the interest costs. And that's obviously been a concern for central banks and governments because we have the biggest step up in the history of the world, and rising interest rates is a threat to that bubble. Because if the interest rates got to a particular level that people could no longer afford the interest service costs, that would then lead to defaults, and that would trigger the biggest depression in world history, which is effectively what Harry Dent has been talking about. And what we can say categorically is that ever since the GFC, the central banks and national governments around the world have done everything they can to stop this depression from happening, and they obviously just add more fuel to the fire, compound the problems, and that's why the debt bubble continues to grow and becomes more fragile and more complex.
Yeah, and just to underscore that very simple point, John, because people often are confused, there's a difference between bond prices and bond yields, rates, right? And so as the price moves in one direction, the actual real return rate moves in the other direction.
Yes.
So when you see the bond rate going up, it means the bond price is falling.
Yes, and the reason why the bond prices are falling is because people are selling the bonds.
Yeah.
We have governments making a series of promises to a whole host of people who have lent the government money, and we now have a situation where people are losing confidence in that promise, because the promise that governments have made is, if you give us a X amount of money, we will give you that money back in full with an agreed amount of interest. Now, where the confidence in that promise is eroding is, well, how much money are you really going to give me back in real terms? So, if you gave the Australian government $100, the government may say, we're going to give you $100 back. But what can that $100 actually allow you to buy in terms of goods and services if you have rising inflation. So what we are seeing is an erosion of confidence in central banks, in national governments, and we'll go into this in a bit of detail, because there is this narrative of we have low inflation. And without putting you on the spot, I mean, you did a show the other day on Walk the World with Stephen Metre where you said you don't see structural inflation. That was your language. Yep. I think the market disagrees with that assessment. I definitely disagree with that assessment. And now we are in a situation where if governments do nothing and central banks do nothing, these interest rates are going to continue to rise up until we have a default moment where some big fish will default, and that's obviously why we have already started to see action from a range of central banks and governments over the last 7 days in particular.
Well, yes, and what John thinks to understand is they are trying to control around the 3-year mark, particularly that particular price point. So what they're doing is intervening in the market to be able to try and keep the rates down at a set level. And then the markets are saying, we're not sure we believe you. So basically the traders there are trying to take positions. Of course, they very much like the volatility because they can trade the volatility and make money. So there is definitely something going on here in terms of traders taking positions rather than having a long-term strategic view of where rates are going to go. That's the first point. The second is, there's a difference in my view between, for example, inflation related to certain commodities like copper, which has gone up, and wages growth. Wages growth is really, really low in almost all Western countries at the moment. And if you compare that with the 1970s, where actually wages were quite strong and actually was the trigger of inflation, not seeing that at the moment. That's one of the reasons why I still am not convinced that necessarily the inflationary story is actually going to play out.
Well, the market is effectively calling the RBA governor basically, either maybe a lie is too strong, but not telling the full version of the truth. Now, we've been calling out the RBA governor, for quite a few years, saying that he continues to lie and misdirect about the state of about the Australian debt bubble, the Australian property market, etc. So it seems that the bond market has, and the bond traders in Australia have finally caught up to what we've been saying for several years about the RBA governor. Now, that's point one. Point two is the implicit assumption in this statement is the Phillips curve. So there was an economist in the last century who took about 50 or 60 years of data and found that there was an inverse relationship between inflation and unemployment. His surname was Phillips, that's why we call it the Phillips curve. And basically, this statement is assuming that Phillips curve is true, so that inflation will go up once we have a tight labour market. We need, and that's where we get the wages growth. Therefore, we need to maximise employment. Now, again, a lot of this was the basis of Keynes's theory, Keynesian economics. In the 1970s, that blew up because unemployment and prices rose simultaneously. That's not supposed to happen under the Phillips curve. And if my thesis is correct that we have stagflation, what this statement is showing is that the RBA is going to be caught out because they're assuming that we're not going to have any inflation while unemployment is relatively high because of the pandemic and everything that happened in 2020. Now, I think they're going to be caught out, but if people want to understand what is driving the thinking of the RBA, it is this Phillips curve Keynesian paradigm, and we do know from history that this paradigm has been proven to be false, and I think they're going to be proven false in the next 1 to 2 years as well.
Right, and just to be clear, John, he is drawing, and it's the point I made earlier on, a direct link between inflation and wages growth.
Yes.
Right. So basically, the argument is until we see wages growth, inflation, we don't have to worry about it. We won't see wages growth until unemployment goes down, because once unemployment goes down, people will actually have to be paid more, and therefore that's how it all works out, right? But the point is there are a whole bunch of reasons why wages probably won't rise. And as you said earlier on, there are other indicators of potential stresses and strains in the economy which suggests that maybe inflation is not as low as he thinks it is. John, just to underscore one thing, right? I still don't know whether we are clear about whether the outcome is deflationary or inflationary, right? I can still play it two ways from this point, but it rather depends on what central banks do, how much more quantitative easing they do, all those things, right? It's still not clear to me what those two futures look like.
Well, I mean, so what we can say objectively is that we have had crisis points in the last 13 years since the GFC around the world, and every time there was a crisis point, whether in Europe in say 2012 with the Greek crisis, or the repo crisis, or COVID-19, at every crisis point, the central banks have done everything they can to stop the deflation story from playing out. And so I do expect them to try again. That's why I think we are headed towards, so like I said we had stagflation last year. I said we're going to have accelerated stagflation. I think that now that central banks are now forced to come up with new policies in response to this bond crisis that has emerged in the last 2 weeks, I do think that the inflation story is going to get worse over the next 12 to 24 months. And that, again, from an individual point of view, you have to be very cognizant of have you arranged your financial affairs for an inflation environment or a deflation environment? And I think our audience knows I've prepared for inflation. I think maybe you've prepared somewhat for deflation, and we'll see what happens to our wealth as we go forward.
Well, yeah, I would say I've tried to protect upside and downside because I'm not sure which way it's going to go. And I just make the point: Bank of Japan has been at this the longest. No sign of inflation in Japan. Eurozone has been at this second longest. No sign of inflation. In fact, deflationary pressures there too. So this quantitative easing journey that the central banks have been on, right, and some have been on it much longer than the Reserve Bank in Australia, hasn't necessarily led to an inflationary outcome. Interesting to see whether that changes. It may not.